If you are in your 30s, there is a good chance you already carry life insurance, or at least you have thought about it. It feels responsible, and it is. But here is a question that often gets skipped. What happens to your finances if you do not die, but you simply cannot work for a long stretch because of an injury or illness? That is the gap disability insurance is built to fill, and for many working adults, it is the more likely scenario during their earning years. Think about it this way. Your paycheck is the engine behind almost everything else. Your rent or mortgage, your groceries, your retirement contributions, even the premiums on that life insurance policy. Life insurance protects the people who depend on you if you are gone. Disability insurance protects your income while you are still here but unable to earn it. In this video, we will look at the odds people tend to underestimate, the policy definitions that quietly decide whether a claim gets paid, and the timing features that change the dollar amount you actually receive. None of this is advice for your specific situation, and rules and prices vary widely, so treat this as a map, not a prescription. Most of us instinctively plan for the dramatic, low-frequency event, death, while overlooking the longer, quieter risk of being unable to work. During your working years, a disabling injury or illness that keeps you off the job for months is statistically more common than dying before retirement. Industry and government sources have long pointed out that a meaningful share of today's 20-somethings will experience some period of disability lasting many months before they reach retirement age. The exact figures depend on which study you read and how disability is defined, so treat any single number with healthy skepticism. The point is not a scary statistic. It is a shift in perspective. Disability does not only mean a catastrophic accident. Common causes include things like back and joint problems, cancer, heart conditions, complications from pregnancy, and mental health conditions, the kinds of things that can interrupt a career for half a year or longer without ending a life. When you frame it that way, the question changes. It is no longer only, what happens to my family if I die? It becomes, what happens to my budget if my income stops for 12 or 18 months while I recover? For many people in their 30s, the honest answer is that savings would run out long before the paychecks came back. It helps to see disability insurance and life insurance as teammates, not rivals, even though this video leans into the case for disability coverage. Life insurance is designed for one job, replacing your economic value to others if you pass away, so dependents can keep paying bills, cover a mortgage, or fund future needs. If no one relies on your income, the urgency of life insurance can be lower. Disability insurance does something different. It replaces a portion of your own paycheck while you are alive but unable to work because of a covered illness or injury. Notice the word portion. These policies typically aim to replace somewhere in the range of roughly 60% of your income, not 100%, and the exact amount depends on the policy and insurer. That design is intentional, partly to keep some incentive to return to work, and partly because individual benefits are often tax-free when you pay premiums with after-tax dollars, though tax treatment varies and is not something to assume. The takeaway is simple. These two products answer two different questions. Many financial educators argue that during your prime earning years, protecting the income that funds everything, including your life insurance premiums, deserves at least as much attention as the death benefit itself. Now we reach the single most important detail in a disability policy, and it is one many buyers never examine: how the contract defines disabled. Two policies can look similar in price and benefit amount, yet behave completely differently because of this definition. An own occupation definition generally pays benefits if you cannot perform the duties of your specific occupation, even if you could technically do some other kind of work. Picture a surgeon who develops a hand tremor. Under a strong own occupation definition, that surgeon could be considered disabled from surgery and still collect benefits, even while doing something else entirely. And any occupation definition is stricter. It typically pays only if you cannot perform the duties of essentially any job for which you are reasonably suited by education, training, or experience. Under that standard, the same surgeon who could work in another field might not qualify. There are also hybrid definitions that start as own occupation for a period, then convert to any occupation later. None of these is automatically better or worse. Own occupation coverage is usually more protective, but tends to cost more, while any occupation is often cheaper with a narrower payout. The right fit depends on your career, your finances, and your risk tolerance, which is exactly the kind of judgment a licensed agent can help you weigh against your situation and your state's rules. Even with the right definition, two timing features quietly control what a policy is worth to you in real life. The first is the elimination period, sometimes called the waiting period. This is the stretch of time between when your disability begins and when benefit payments actually start. Common elimination periods run anywhere from about 30 days to 90 days, and sometimes longer, like 180 or 365 days. Here is the trade-off in plain terms. A shorter elimination period means money arrives sooner, which feels safer, but it usually raises your premium. A longer elimination period lowers the premium because you are agreeing to cover your own expenses for longer before the policy kicks in. So the elimination period is really a question about your emergency savings. If you have a solid cushion that could realistically cover several months of bills, you might tolerate a longer waiting period and a lower premium. If your savings are thin, a longer elimination period could leave a dangerous gap precisely when you have no paycheck. There is no universally correct number here. The honest exercise is to look at your actual savings and fixed expenses and ask how many months you could survive with no income, then match the waiting period to reality rather than to a default someone suggested. The second timing feature is the benefit period, and it answers a different question. Once payments start, how long can they continue? Benefit periods are often expressed as a number of years, such as 2 years, 5 years, or 10 years, or as a duration that lasts until a certain age, frequently around age 65 or 67, roughly the threshold of traditional retirement. A 2-year benefit period costs less because the insurer's maximum exposure is capped, but it would leave you on your own if a disability stretched beyond that window. A to-retirement benefit period costs more, yet it is designed for the scenario people fear most, a long-term condition that ends a career years early. When you combine these features, you can see how two policies with the same monthly benefit can be worlds apart. One might pay quickly but only briefly. Another might make you wait longer but then protect you for decades. Reading these terms together, the definition of disability, the elimination period, and the benefit period, is how you understand what you are truly buying. Prices, available options, and even which features are offered vary by insurer and by state, so the printed illustration matters far more than any general rule of thumb. If this has you wondering where your own coverage stands, a calm, practical starting point is to find out what you may already have before buying anything new. Many employers offer group disability coverage, sometimes short-term, sometimes long-term, and it is worth checking the details rather than assuming it is enough. Group coverage is convenient and often lower cost, but it can have important limits. Benefits may be capped. The definition of disability may lean toward the stricter any occupation standard, and employer-paid benefits may be taxable when received. Coverage usually also ends if you leave that job, which matters in a decade when people change employers often. Individual policies that you own are portable and customizable, but they require underwriting based on your health and occupation, and they cost more out of pocket. Some people use a combination, leaning on group coverage as a base and adding an individual policy to fill the gaps. There is no single right structure, and what makes sense depends on your income, your health, your savings, and your state. Public resources from your state insurance department and official consumer sites can help you understand the basics, and a licensed agent can compare specific products. The goal here is informed questions, not a rushed purchase. So where does this leave you? In your 30s, your single biggest financial asset usually is not your home or your portfolio. It is your ability to earn an income for the next few decades. Life insurance protects the people who depend on that income if you are gone, and it has a clear and important role. But disability insurance protects the income itself while you are still here, which addresses a risk that is, for many working adults, more likely to occur during these years. That is the heart of the case made in this video. Not that one product beats the other, but that income protection deserves a seat at the table it is often denied. The most useful next steps are unglamorous. Find out what coverage you already have through work. Read how each policy defines disabled, paying close attention to own occupation versus any occupation language. Match the elimination period to your real savings and the benefit period to the length of risk you actually want covered. And remember that availability, pricing, tax treatment, and rules vary by state, by insurer, and by your personal circumstances. This video is general information, not financial or insurance advice. Consult a licensed agent or official sources to decide what fits your situation.